Market overview: Wall Street navigated a quiet yet highly tactical session to start the trading week, as major equity benchmarks drifted through narrow intraday ranges while digesting last week's severe technology liquidation. Buyers and sellers engaged in a cautious tug-of-war on the floor, balancing early session resilience in semiconductor leaders against mounting macroeconomic pressures from rising Treasury yields and elevated crude oil prices. At the closing bell, the broad market S&P 500 dropped 14.41 points, or 0.19%, to close at 7,443.28, marking its third consecutive session of minor consolidation. The Dow Jones Industrial Average experienced the heaviest relative drag among the benchmarks, sliding 307.16 points, or 0.59%, to settle at 51,839.26. Meanwhile, the tech-heavy Nasdaq Composite demonstrated firm relative defense, edging lower by just 12.17 points, or less than 0.05%, to settle at 25,508.07. The broader market felt steady headwind pressure from the fixed income market, where the 10-year U.S. Treasury yield advanced to 4.59%. Bond yields climbed alongside WTI crude oil prices, which pushed toward $83 per barrel amid escalating geopolitical tensions in the Middle East. This macro environment sparked a distinct sector divergence, favoring energy producers while keeping broader equity multiples constrained ahead of a high-stakes corporate earnings week. The winners column was led by high-conviction artificial intelligence infrastructure plays and defensive energy producers. Data center operator Hut 8 emerged as the session's standout performer, surging over 10% after announcing a monumental $9.8 billion artificial intelligence data center lease agreement. Simultaneously, technology mega-cap Alphabet Inc. drew intense institutional buying in early trade, gaining over 3% intraday following reports that the company is deploying a new custom internal AI processing chip to optimize cloud infrastructure costs. In the semiconductor hardware layer, key players steadied after last week's sharp decline. Nvidia added 0.2%, while memory maker SanDisk jumped 2.7% as buyers stepped in near key technical support levels. Defensive energy heavyweights also captured steady capital inflows as rising crude benchmarks boosted operational margin expectations. Sector leaders Chevron and ExxonMobil both closed securely in positive territory, benefiting directly from institutional portfolio managers hedging against sticky inflation risks. Conversely, legal developments and geopolitical pressures created distinct pockets of weakness across consumer discretionary and media equities. Warner Bros. Discovery dropped 3.8% after a federal judge issued a temporary 2-week restraining order halting its planned $81 billion merger with Paramount Global, allowing state attorneys general additional time to pursue antitrust challenges in court. Global footwear and apparel leader Nike also faced institutional selling pressure, sliding as mounting geopolitical frictions in key overseas markets raised concerns regarding international consumer sentiment and supply chain stability. Meanwhile, small-cap equities lagged the broader market, with the Russell 2000 index falling 0.7% to 2,942.43 as elevated borrowing costs continued to weigh on debt-sensitive smaller enterprises. Industrial and aerospace names also gave up ground, acting as the primary weight drag on the Dow Jones Industrial Average. Allocators trimmed cyclical manufacturing positions to reallocate capital into liquid energy hedges and short-term treasuries. An isolation of the 11 primary S&P 500 sectors highlights the defensive posture assumed by institutional allocators during Monday's session. Communication services and energy led the sector performance matrix, providing essential ballast to the broader market. In contrast, industrials and technology finished at the bottom of the sector scoreboard as portfolio managers selectively pared back high beta growth exposure. This cautious stance was visible across broad market exchange-traded funds. The SPDR S&P 500 ETF Trust, SPY, and the Invesco QQQ Trust tracked their underlying indices into mild negative territory on moderate trading volume. Meanwhile, small-cap thematic funds experienced notable net outflows. The iShares Russell 2000 ETF, IWM, underperformed its large-cap peers, confirming that capital flows remain heavily biased toward cash-rich mega-cap balance sheets. Heading into the middle of the trading week, institutional focus shifts entirely toward a massive wave of second quarter corporate earnings reports. First, keep an absolute focus on upcoming mega-cap technology releases, led by Alphabet and Tesla. Portfolio managers will parse these reports to determine whether current AI infrastructure spending is translating into durable revenue growth or if valuation multiples require further compression. Technically, market participants must monitor the S&P 500 as it tests immediate technical support at the 7,440 level. A firm defense of this baseline tomorrow could spark a technical bounce towards 7,500, whereas a breakdown would open the door for a retest of its multi-week moving average. We advise maintaining a disciplined, quality-oriented investment approach. Focus on companies with strong balance sheets and transparent margin guidance while closely monitoring the 10-year Treasury yield near 4.59%. That concludes the update. We will see you at tomorrow's opening bell.